Over the last 48 hours, we've talked about dark pool activity at the highs. Since then, the market has fallen off, proving that Wall Street was up to something sneaky. But will they continue the sells through to the US election? And more importantly, what opportunities, according to the data, are best right now in the markets? Well, when we look at the percentiles, you might be surprised. And we've got some absolutely crazy data to share with you today. That, along with our thoughts on the US 10-year rising and whether we should be concerned, and of course, Tesla's earnings. A deep dive into whether this is good, bad, or ugly for the stock moving forward. Stocks, commodities, and cryptos coming up in today's show. We'll see you very soon. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss because, of course, it was a sea of red across multiple big tech stocks over the last 24 hours, and it kind of aligned with some of the big dark pool activity that we've seen on the channel. If you're new here, remember to subscribe and smash that bell icon if you love markets like we do. But let's get into the big storylines today. And we're going to start with the same chart that we did in the previous video because I think it's so important to the current market condition. We saw an all-time high in September. Now, if you know anything about seasonal data, you'll know that September tends to be a weak month, especially in election years. That was not true in 2024. And because we made an all-time high, remember that means that the end of the year probably is going to be positive based on the stats, and that there could be a decent drawdown in the vicinity of even 4 to 6% leading at some point into the year end. Now, this becomes important when we're starting to look at the key fundamentals underneath the market and the strength across the board. These are just some of the key reads that we've seen in recent months, including all-time highs for so many different markets. Whether we're looking at Dow Jones Utilities, transports, composites of the Dow Jones 65, equal-weighted markets, cyclical markets, financials, or anything else, they all seem to be making all-time highs. Now, this will have changed over the last couple of days, but that's a good read of breadth underneath the hood. And what that tells us is that the market could be just getting started with a move into some of the other sectors. And you may have heard a lot of people talking about this over 2024, the rise of Russell, the rise of the Russell 2000. And we haven't really seen it come through until possibly around the last couple of months. Now, why is this important? Because the spread between the 500 and 600 stocks is now in the 96th percentile. And let's just say that doesn't tend to sit around forever at these levels. Now that we're at this extreme kind of percentile, we can kind of start to say, well, maybe it's time for catch up between the 500 to 600 stocks. And this gives everyone a unique opportunity to potentially be looking at the midcaps, which we'll be focusing on in our weekend video. So make sure to subscribe so you can have a look at what we're talking about when we're going through midcaps moving forward. Now, why could this be? Well, when we look at US equities, it does look like a lot of them are stretched pretty heavily. And you can see here, bubble resistance levels are proving formidable, whether it's the PE on a 12-month forward basis for the S&P 500, or it's the PE on trailing peak GAAPs, or anything else. Basically, they're all up near those highs. Not quite at 2021 levels yet, or even the dot-com boom, but they're certainly up there. Now, we're not seeing that across the board, though. If you actually look at sectors, you'll be pretty not surprised to know that infotech is now trading at the highest forward PE versus the median. But actually, a lot of other sectors are still trading well below. Energy, for example, is trading at a negative 38% delta, while some of the other markets that are usually associated more with, let's call it, mid and early cycles, they're all trading at very nice kind of positive deltas. Notice where the problems are. Well, of course, utilities, one of our favorite sectors of the year, is still trading well underneath its overall forward PE. So you might hear utilities is expensive, but of course the street is expecting it to do quite well off the partial AI trade / other things. Consumer discretionary and other markets as well, while they're trading high, you can see here that some of them haven't come back in line. And where the real big discrepancy is of course the small caps versus the large caps. We have some charts that we've shared over on X, so I encourage you to go and click on that after watching today's video, and you'll see on there the difference between the forward PE of the Russell 2000 versus the forward PE of the S&P. Quite a large gap, and certainly something to be looking at. Now, we know that Citi, we know that other people such as Mark Newton are all kind of starting to call for some form of correction. Now, some of them are saying 10%, Some of them are saying just a smaller correction. But in general, we have become quite FOMO when it comes to sentiment reports, and obviously we're extended on the markets. This allows us to have what we call a pullback in time or a small correction. And while we don't believe on the channel we're getting a 10% this year, because of course we think that's more likely in 2025, I think all of us can agree that the market has been on a pretty good tear. And although it had incredible pullbacks in August, which we of course were very bullish on, the market is always due for some form of pullback statistically. Now, you can go through and you can actually see that usually we are due around a 10% pullback. I would argue we got one similar in August though, with the NASDAQ falling over 10% and the S&P 500 not quite falling it. But remember, if we go and follow kind of the 1960s concept, and we are following this, if we do get a small pullback at this point, then we may be getting another bigger, larger pullback in 2025. And I would say this could either happen January all the way through to the first 6 months, and the last part of 2025 is where we start to get a little bit more problems. This is one of the ways that we're reading markets at this stage. Now, we did mention the Russell 2000. We obviously know there is a difference between the overall metrics because we can see it's in the 96th percentile. But we also know that if the Russell is going to do well, it tends to do well in November. So it's not so much what's happening right now that needs to be looked at and saying, oh yes, it's good or bad or ugly. It's what will happen in November. The seasonal run that hasn't happened for a couple of years now because we've been more in the beginning of a bull cycle could start to come through. And Russell seasonality for this period of the year tends to be the best. Now, why is this also important? Well, it all has to do with the earnings. And we know that this week is 33% of the earnings. Next week is 28%. More importantly, the largest tech companies will come out. And then, of course, we go into pretty much the back end of earnings. But it's going to come down to whether everything's living up to expectations. And even if it doesn't quite live up to expectations, remember the market will sell after a lot of these usually happen. Then what will happen is they'll kind of flush out retail traders and say, oh, well, it didn't quite meet expectations, let's say, and then they'll buy it back up. That's why we use technical analysis, and we use, of course, options markets, which we'll look at in a moment, to really figure out where these buyers, where Wall Street is actually picking up positions and potentially selling into us as retail traders. So we got the Tesla move, and it looks like it's a good one in terms of the market took it very seriously and just bulled it all the way through the after hours. We'll look at that in a moment. But these are still some of the big market moves to come. Remember, these expectations here are the plus minus in terms of the overall options expectation for the market. Now, as always, when we're doing Tesla, we need to talk about AJ because AJ does some pretty good work on Tesla and reports. And it looks like AJ's gone through the Tesla report and he's said that things are looking pretty good. Now, he is pretty bullish on Tesla, so I will say that first up. But effectively, operating cash flow, free cash flow, exceptionally strong, which is a good sign. And free cash flow is very strong on an all-time high. So, of course, the trend for free cash flow, as you'll notice in a moment for automakers, is actually doing quite well. The energy storage business with margin exceeding 30% while being production constraints. So, of course, that's something that hopefully they can work on. And all this while remaining super lean. Operating expenses actually decreased for this particular quarter. Net income would have exceeded $3 billion without large other expense items and additional restructuring charges. So it looks like on the surface, some things have improved with Tesla. Let's take a look now at Tesla versus other automotive companies. And you'll see straight away why I usually don't like automotive companies. Have a look at their free cash flow history of pure EV makers. Oh, so terrible. However, Tesla has actually turned, of course, the ship at this point. And this is important when you look at it in the context of every other one. Now, I am not a fan of these automakers, as you know, if you've been watching the channel for a while, because they are all usually loss leads. And I just don't like that kind of consumer discretionary style. But Tesla's operating cash flow did hit a record here, as you can see. And also their free cash flow was up big time. Not seen since the September one last in 2022. And yeah, I think it's a big deal. You know, obviously the market likes this type of thing. The deferred revenue is being made a big deal of. But as we can see here, whether we're looking at deferred revenue in either case, it's not like it really went up. It's just kind of sitting there. And this is often a tell when you're looking at kind of the fundamentals in a market. If they keep doing this deferred revenue stuff, that could be a bad kind of payment or something that's not ever going to get paid. So we've got to remember that. Now let's go to the big stuff though. We'll come and revisit Tesla in terms of the stock market action later on because it is very interesting. And it's pretty much done exactly what we would think as well in terms of the aftermarket trade. And the SPY and the dark pool. So the SPY and the dark pool, we know that we had a large transaction up here at the highs. We know that that may have led into a bit of a sell. And it's just along with the lines of everything we've been sharing in recent days. Quite a few different dark pools across the Dow, the Russell, the S&P and the Qs. And when they're happening at these highs and we get a bit of a price action pullback, that can mean that, of course, there might be a little bit more to come behind so that Wall Street can rotate back in and pick up the dip. And I would say they're trying to buy the dip, whatever the excuse is in terms of the sell. Now, let's take a look at Baba. Large trade, obviously dropped past this trade. That's not unexpected. Remember, with China, this is going to be a positioning-based structure, and we know that it's a fight between the PBOC and the market. So the market is going to say, where's our stimulus? And the PBOC is going to say, yes, it's coming, it's coming, it's coming. Don't worry, we've got your back. It's unlikely we see any major stim until after the US election. So just remember that, and that therefore could degrade the market further before it goes up into 2025. Now let's move over to coin. A lot of transactions everywhere. This just shows you what's kind of going on with crypto markets. We obviously will be watching very closely coin at around the 225 mark. If it does get through there, we would expect Bitcoin to also be making a new high and things to be looking quite good in terms of flows. And then there was treasuries, which has started to get a bit of position-based buying. Now, a lot of people are concerned about treasuries and the 10-year, and we'll go through the 10-year in a moment, but don't be concerned about the 10-year. The narrative here is completely wrong, I believe, from the market, and we'll discuss that in just a moment. Let's now go to rotations. Utilities was number 2, not number 1, but getting close up there. KRE with a little bit of a hold, and basically gold stock falling off, which we expected. As we've been talking about, gold probably has hit a temporary high for now, and we'll go into a bit of consolidation thanks to mostly the silver trade. Gold stock is the best on the 5-day, which is again to be expected. Utilities doing okay. No real super defensive section of the market, but most notable home builders down big time at 6.83%. Now let's move over to the S&P 500, and we've got the advanced decline line down the bottom here, guys. And as we know, the advanced decline line should always be pointing up, ideally, if we're going to get nice big market moves. Well, it has actually started dropping. Now, it's dropped over the recent days with, of course, the larger dark pool transactions, and it continued to drop over the last 24 hours. This is in line with what we discussed, which was basically a huge amount of bad breadth that came through on Monday of the trading week, and maybe that was a precursor of this little bit of a pullback. So can we make a case for buyers here? You can actually make a case for that, and you're going to have to watch it very closely. Notice we're back at the daily 20 moving average. So obviously this could be where we see a buyer come in. And as we reported over our last couple of sessions, if we manage to get down into the 5780 area to 5800, we would expect a buyer to try to recommence around there. But if you're a bear, while this may look like a big rally, it's all going to come down to around this level here. 58.40 to 58.50. Not only is it an options high level for the next 24 hours, but it's also now a heavily traded zone. And this basically means that if this is a bearish structure, this should be where we get reaction from that bearish structure and push back in. Now, if we keep pushing through here, we'd have to think we're making a new low and we're going to push into that 5,700 level. And 5,700 in particular would really mark in quite a lot of decent types of trends. It would firstly bring us down to, I think, a very key level. It would also give us around a 3% sell-off, which is, pretty much in line with what we've seen in that data before with the all-time high making in September. And I would like it quite a lot. So far, so good for the market. This type of thing seems like the most likely scenario for now. And that's not an easy call because, of course, the market is inherently bullish. So when you think about it, would I be bearish and sell all my investments? Personally, no, I wouldn't. I think the breadth is looking good and that everything else looks good. But you need to make your own decisions on that. We can see here the daily 20 as well, the bounce off that, the bounce off our first zone. Yeah, it's all working as we would expect. But if we do get a rally, this is the type of thing that I could see moving forward. Do you agree or disagree? Let us know in the comments down below. Always good to see. Let's now go over to why it makes sense for us to possibly go up a little bit over the next 24 hours. And yes, it is options. These bloody 0DTEs that continue to really show themselves to be one of the best trading methods in terms of understanding, which we cover here daily on the show. are coming through big time. Look at the puts of the next 24 hours. Everyone seems to be riding puts between 58.30 and 58.45. And that means that while we are in currently a negative gamma, as we know, negative gamma is harder to stick. It seems like the markets can't quite do that. If the markets do want to kind of eliminate these particular sells, they'll make it back up to, guess what, 58.40, 58.50, which just so happens to be where you would see the bears recommence. Now, notice this. So many puts. It was just people champing at the bit to go negative on this market. Look how many puts there are now for Friday. And this is a fairly big deal because, of course, what it's telling us is that if we do end up holding underneath 5,800, it could create what we call a cascade or waterfall effect. I mean, after all, this is negative gamma if we get into this area again. And, of course, which levels do we think are most powerful? 5,750 and 5,700. And I would expect 5,700 to strengthen a huge amount should the markets actually come back down. To get back into positive gamma now, we're going to really require to get back of 5,900. So I think the market will be neutral to even bearish in terms of its overall structure at this point. And you'll notice that that is really with the 0DTE. So I'm looking forward to seeing the next 24 hours of 0DTEs for next Monday so that we can then start to see whether the market is actually showing signs of really wanting to go bearish in terms of structure. Let's move over to NVDA. We are now underneath 140. A lot of people are now writing articles about how, is this a false breakout for NVIDIA? I tend to believe it isn't, but a lot of people are now writing that article, which is kind of good because it means we could be climbing the wall of worry. Now, does that mean we won't pull back if the market pulls back? Absolutely not. Of course, it will pull back. It's still in around that positive gamma zone. Remember, underneath 140, though, means that if we look forward into November, we're underneath all of these calls. So, yeah, it's still strong stock, but, of course, less strong than it was when it was holding above 140 plus. Now, there's Tesla. You can see here 232.50 are the big calls this week. Well, you might know that after the earnings, we seem to be above this level. If Tesla can stick the day and actually stick the landing, then that could be a big deal when it comes to these markets. So speaking of markets, let's go through some lead indicators before we go through some of the key charts that we're watching right now. First up, the bonds market looks fine. No real concerns there. Second up, we'll go to home builders. As we suspected, this has been one of the weaker markets, and we kind of expect it to continue to weaken. I don't see anything very strong here out of the home builders yet. We've still got things like gaps at 116 and, of course, supports at 112. Now, if home builders do sell into these levels, it doesn't mean a cataclysm is coming or anything, but it does mean that this could be a precursor of further weakness in the markets. When we have a look at KRE, which is an important sector, of course, at the moment, it actually held pretty well. And if we look at financials, you can see they held pretty well. So again, not super scary or anything like that in terms of this pullback. Let's move over to treasuries. Now, we know that everyone is trying to short treasuries at the moment, including my man Druckenmiller. I know he's probably already been short up here. I don't mind the short up here. I don't really understand it here too much. It's possible this or even this could occur, but I think in general, you don't really want to be shorting treasuries. What this is the 10 years going up because, of course, this is the Fed. This is what the Fed said in the dot plot, and the market was pricing in effectively a recession. So it was giving recession cuts. Now that we've seen possibly the idea of a soft landing coming through, or whatever they want to call it, the difference between the Federal Reserve's cuts, which is a slower cut rate, and of course the faster cut rate needed for a recession, has then come back up to more in line with the Fed. And to do that, then you're going to see the 10-year up, and of course you're going to see treasuries drop off. I don't think that's an unexpected trade at all. It's exactly what we've been discussing. The market got ahead of itself in terms of how many cuts they were expecting, and we expect a slower cut cycle here to make it look like there's a soft landing. Then we go through 2025, maybe even to 2026, and they go, oh, whoopsie, we actually have some big problem here. Never lose sight of the uninversion of the bond yields. That's pretty much the big one. It puts you on a timer ultimately. And then it senses, and then you end up going into a false sense of security. Let's move over to the US dollar. The US dollar is, of course, rising up strong. I don't know why anyone's trying to short this. I would not short this at this stage. Of course, we are looking for resistance to be found here. This is why we say patience, react, don't predict. In this case, the trend is up. Don't fight the trend. In this case, it's very aggressive, and clearly a lot of people are trying to kill the dollar. I don't know why. If yields like the 10-year are going up, I would not fight the dollar. Let's move over to copper. Now, copper has improved over the last 24 hours, held the low, little bit of improvement here. I'm on the 2-hour chart. Obviously, a big bull will want it above 4.4, which we've got an alert here. If that happens, I think copper's really done a nice basing structure. Be very careful of this getting wiped. So I could see like that kind of thing happening. So we've got to be very careful there on copper. But so far, so good. Gold, rejection, no unexpected kind of moves here. I think if gold does recover now, it's actually changed to the downside a little bit on the smaller time frames. So if it does recover now, I could see it in a correction that is like a pullback in time correction. And that's mostly due to silver hitting the ratios we wanted. So nice work with silver, 34.60. It's beautiful, guys. Well done. Exactly what we expected. Now we go into some consolidation while everyone talks about silver squeeze and whatever else rubbish they talk about. In general, we always need to be ahead of the game. And with silver and gold, we certainly have been again. Now let's talk US oil, because this one here is probably a bit of a sleeper for a lot of people. Things improving over the last 24 hours, and actually a beauty trade on UK oil. I was covering this in our community, and I really like UK oil in terms of the structure. I think it's given us a bit of a hint of strength. And at this point, if you were looking at something like UK oil, you could be looking at the gap, 78, 80, quite a lot of upside here for the oils. And I would say this is probably one that not that many people are talking about, but things have really improved over the last 24 hours. So not bad chart. Speaking of improvement, Tesla. Tesla takes a new low before the earnings announcement. Then it rips a high in after hours trade. Now you actually could have gotten on the after hours trade. It wasn't too bad. So if we actually go smaller time frames here, I'll show you. So you can see that in after hours trade, we got the initial reaction, went to 224. And if you actually bought right here, I think it's actually not a bad buy at all. If you bought right on that alert that we set, you buy, you place stop, and you go for, can anyone guess? Pause the video. What area would you be going for, guys? If you answered gap fill, then you'd be absolutely correct. Yeah, gap fill was the classic trade after this earnings announcement was coming out. And bam, did it go into it. Look at this thing. Absolutely smashed into the gap fill. Beautiful trade from that aspect. Now we have to ask, can it stick the landing? So, of course, that's all aftermarket trade. This will now look like a gap up. So, of course, it brings in island reversal as the key kind of concept. So let's say we hold, which we're probably going to hold somewhere around there. Then even if we pull back, there's a good sign that this is probably a turning point for the stock to go up. So what's next target? Well, of course, it has to be 260. Now, some people are going on about this going to 300 and stuff. It's possible. But yeah, that's not too bad at all. NVDA still holding the bullish movement. Obviously, we like the fact that the weekly is looking still relatively good, and we'll keep assessing NVIDIA, but for now, so good. HSI, as we mentioned, Barber obviously dropped off. There's no expectations here of this being an exceptional trade. It could do this. In fact, I think that because this is actually just a PBOC versus the market kind of thing, it's just going to be really about news and catalysts. So this is a news catalyst trade during recovery. US 30 down to the daily 20 moving average. No surprises. Everything is down to the daily 20 moving average. So again, another potential support. US 2K actually hit near our line yesterday at 21.93. And this is an interesting position-based buy. Remember we mentioned before the difference between the S&P 500 and 600 spread. Well, that's suggesting that the Russell 2K and anything past the 500 to 600 bracket as well is underpriced on the metrics. So again, go and have a look at our X, follow over there, and I'll have a chart up with the Russell 2000. So at least you can see the mid-cap valuations and small caps. NASDAQ, again, comes back down to the daily 20. I think the S&P is the best read, maybe a rally up with possibly a sell-off. So will the bears control it? Well, they're going to need to control that 58.40, 58.50 level is probably the key zone to be watching. When it comes to crypto, Solana's the new king. Well, at least it's the new Ethereum. Solana absolutely smashing Ethereum. This was actually brought up by a member of the community. I totally agree. That's why I've been following this chart. You can see here Solana's power versus ETH. So it's definitely the altcoin at the moment. But if we go over to the king, which is still Bitcoin, you'll notice it's got some nice bounces off that first level that we like. And I put in a new level, 67,850. Now, if that gets closed above, this could actually strengthen to a new high. And that may be the pullback that we get. Remember, our case scenarios were this. Well, Actually, we better draw that again, guys. This or this. They're my two main case scenarios. Still bullish on crypto, even with the market keeps pulling back a little bit. I don't think the market's going to go into a cataclysm or anything, so it's more than likely Bitcoin's still looking all right. A little bit of fighting to do because some people will argue this is actually now in a small time frame downtrend and that it could do this, which is totally possible. But either way, these are the two main levels. We'd like to see some buyers come in and commit, and obviously we are looking at those zones. For Thursday, really all that matters is pretty much the earnings and the flash services PMI and manufacturing PMI at 9:45 New York time. And as always, guys, if you're enjoying today's video and you want to know more about what we do, check us out over on X. Check us out in terms of our flash sale on our courses. If you want to see some of the replicable trades, day trading masterclass in particular will help you out. And as always, make sure to always consider your risks in markets. Remember, if it's in the press, it's in the price. Patience, react, don't predict. Don't let Wall Street get a free lobster on your money. Bye for now.